got my regular Tuesday guest, Brandon Potts back. We did have to skip last week because he had some business to take care of, but good to have you back, man. How's everything been?
Oh, everything's been good. Yeah, last week, my banker who does all the financing for the new constructions, it's a good friend of mine. That was the only time she could do it was come out there to those builds. We'd planned it for my wife, who has never seen the builds herself. So my wife and I, and she took us to lunch and we visited about the builds and kind of our plans over the next 2 years. So that was an important meeting I really couldn't skip.
More important than me?
I'm sorry, the guy
Well,
the person giving me the money is pretty important.
yeah, I ain't giving you nothing, so
Unless
you
you're going
can
to start
skip.
ponying up.
Well, this topic we're going to talk about, we actually had it planned for a while, so I kind of forgot what the main topic was, but I know you really want to touch on active versus passive returns. I forget though, was it related to a video that came out? Someone was talking about, and
Not
you kind of
um I think it was something Zuber and I talked about. The genesis of it was talking about owning real estate. You're a small E entrepreneur. It's more active, especially at the beginning. So that was the genesis. And then there was somebody made a comment that spurred another thought of discussion in it. And so I thought I would just share my perspective on passive versus active because my opening statement is everybody wants passive income. Everybody wants passive investments. But when you're going after passive initially, it costs you hundreds of thousands of dollars of compound returns over years. And I think you should go after it should become more passive over time. But those that want to optimize their returns to get to financial freedom, it has to be a form of active investing, at least a bit at the beginning. And I call it becomes a small E entrepreneurial business, but over time, a good, well-run business becomes increasingly passive. So I can talk about it two different ways. Me as an entrepreneur that has started multiple businesses, I have made them, and I'm thinking back even to my 20s, some of my earliest businesses, it stayed active and the business did not function well enough to become increasingly passive. And I learned over time through more businesses that I started that yes, it is active at the beginning. So active, I'm putting in lots of time. And there was, a story back when I was starting my real estate company, the sales company, I'm putting in, 60, 70 hours a week. And there was times I didn't even know what day it was. I missed holidays. I didn't know what day it was, but I knew that effort was going to pay a return. And so it was very active. But then over a few years, as I began to stabilize it and then eventually optimize it, I got to where I was only putting in 15, 20 hours a week. And if you put that by what I was making per hour, it was hundreds of dollars per hour of actual time. But it took a few years to become increasingly more passive. It never became completely passive, and I don't think very few things ever do. If you even invest in the stock market, you are looking and managing your portfolio and optimizing it throughout the seasons of life. You're having to make adjustments. You are making some active participation. You're not just handing somebody money and never touching it again and just getting this mailbox money. If you are, you're going to make lower returns. So that's what I talk about is I'm thinking about even me as a business owner. It was active. It has become increasingly passive as I've optimized that business. The same thing comes here in real estate that when we start, if we're wanting to make the optimal returns, there has to be some form of active effort.
What would be considered passive? Is there any type of investment now that is you would categorize as passive? So maybe an
I think
example of
everybody
each.
thinks more of I'll go for regular investing is investing in the stock market. They think of that as passive investing. And if you take that, let's just take an example of using the stock market. Most people invest in uh, mutual funds, and then it's creating some form of return or increase in value. Or the S&P 500. I'm going to invest in the S&P 500. It's going to be very passive in my involvement. Well, it has a cost. You're saying you're saving time, but I actually say you're increasing your time because you're increasing your time to get to financial freedom. It has a cost. Every activity has a benefit and a cost. It doesn't work in a vacuum. S&P 500 for 25 years, from 2000 to 2024, the actual return on those 25 years was only 7.3% average return a year. If we take that and say, am I going to get to financial freedom? You're going to have to, the only way to get to financial freedom with those kind of returns is you're going to have to pay an inordinate amount of dollars. And where are you going to get those dollars? You're going to have to put in time for something else to have those dollars to put in. And then it's taking you that much longer to get to financial freedom. Active investing is returns of 14% and higher. That's where your active investing typically lands. There may be a few that get a little higher than that, but not consistently. The other form on the real estate that's more passive is the you're buying fractional shares of investing, or you're buying syndications. That's increasingly passive, and you're making less return and you have even less control over your own destiny. And I think most of us that get into investing in real estate, part of that decision is to increase the returns and feel like you have more control over your destiny. So that's kind of some two examples.
So I know you brought up the stock market and that. What in real estate? Is there anything in real estate that would be considered passive? Like, would you
That's what I'm saying,
consider oh,
syndications and maybe
okay.
fractional ownership of real estate and real estate investment trust. That's on the Wall Street product. That's their product for that. But syndications, REITs, and maybe fractional investing, which I don't know it super well. So I'm not saying I know everything about that system, but I do believe you have less controls.
I think for me though, the one thing is that people are more afraid, I think, of being active investors. So that's why, they like retirement accounts, it's just easier for them to have it taken out of their paycheck and whatnot. So how do you think we can get people above or past that fear of being a little more active in their investments instead of just relying on, like you said, retirement accounts or putting it in mutual funds and to that sense?
I think where you get action for people, people act based more on loss. You'll get more actionable change from the fear of loss than from the fear of gain. When you find out, hey, if I go the passive route, my loss is my financial freedom when I'm healthy. It's going to take you maybe decades. I mean, these are all, theoretical discussions, but it could take you extra decades to get to financial freedom. That loss could spur the action versus getting into it and making higher returns and doing it on a small scale at the beginning to where the potential loss is not so catastrophic. Going after, and I think that's where Michael Zuber helps break down some of those fears, is you don't have to jump in with a 30 unit multifamily complex. Start out with one single family or one duplex, something smaller, and learn with it over time. But I think a lot of times, fear of loss of something causes more action than fear than uh, options of gains.
Hey, Luke Howard is tuning in. Says good morning,
Hadn't heard
Brandon.
him in a while. Yeah.
Yeah, he says been a while since I've been able to tune in live. Said classes in session. I forget. I mean, I know Zuber's story very well, but I can't remember. Oh, he lost money. That's right.
He
Right. He
lost
lost
money.
money,
So
and then
his
that's why
his
he.
loss spurred his action.
Yeah, I don't. I didn't even that. I don't think it always has to. Well, there's always a loss, like you're saying. There's always some relation. It doesn't have to be financial loss, but
Yeah,
I think there's
it's
always something. So even like right now, and I shouldn't bring it up too much, but like for our fire department, we had a very bad or poor arbitrator decision on our upcoming contract. So now there's this uproar in the department, and in our department Facebook private groups and all that. There's people very concerned about the direction the department's headed, right? So, and then this is part of the reason why I keep telling these guys that the pension and whatever steps or promotions they're hoping for, right? It's not guaranteed. I mean, well, the pension to if, as long as you meet certain requirements, but to rely on that solely as your retirement, hopefully this decision by the arbitrator will maybe light a fire under some individuals to maybe seek other opportunities or investments, and then not solely rely on this fire department pension and everything.
well, and in every decision, and this is where I was. I wanted to control my own destiny, and that's a big deal to me. When you anybody, let's take pensions. Are they making the best decision for you specifically? The answer for everybody is no. They're maybe making the best decision for them or the best decision for a group of people that might not be the best decision for you. And that's where I was. I don't want to have somebody I've watched in my decades of life. Nobody makes the best decisions for me and my family other than me. There are nuances in this. And so what the way I was going to optimize getting to financial freedom faster was taking increasing control over my own destiny to make the best decisions for me, my wife, my family. The positives to it, there is a cost. You go into a retirement account, it becomes increasingly passive in a 401k. The statistics prove it. It's not my feelings, I'm talking facts. Only 3 people out of 100 ever reach $1 million in wealth in a 401k, a value of a 401k, because you're giving up returns for somebody else to make decisions. You look in real estate when you're active investing, making good decisions, the actual portfolio, let's use that 7.3%. It is pretty easy with good decisions to make above 7.3% total because you're making returns, not just cash flow, but healthy leverage, principal pay down, appreciation over time, the tax benefits of not having taxes, all of those things. It is triple, quadruple, 5 times that over time. In return, you get to financial freedom that much faster and you have more control and you're making the decisions. And I look at it, I like the control because if I fail, I don't have anybody else to blame but myself. And that's on me. But I'm going to fail less because I'm making the decisions that are in my best interest.
To that point, I think like the fear of losing money, also where the economy is, or there's so much noise right now and volatility, and so do you think it also helps to be more of an active investor in volatile times, or would you rather be more of a passive investor?
Oh, absolutely. More active. Let's look at the stock market. So we're investing in something. And I could say stock market, I could say Bitcoin. I could bring all of that. When you're investing, I know I'm bringing up, but when you're investing in the stock market, you're investing that the value will increase 20, 30 years from now. You have no control over it, and what they value and what people value changes all the time. That's almost to the point of speculation, like Bitcoin. It is speculation because it's not traded on value, it's traded on price. Now, the stock market has some value component in it when these businesses earn income, but it's still a value perception over time. There is some of that with real estate, but real estate creates a cash flow. But real estate works all those different components from cash flow to principal pay down to tax benefit to appreciation. They all work independently from each other. My rents have come down, and y'all know I created that video on that last week. My rents came down, but I increased my cash flows because I was actively managing disputing property taxes, working on my insurance, doing some refinances. If I'm in a syndication, do I have any direct control unless I am the operator of it, the operating manager? If I'm not, I don't have control over those decisions, and maybe they don't have the relationships I have. I don't know. I'm just giving examples where being an active participant, I can increase the returns and get to financial freedom. Over time, you see a lot of these investors with Zuber, with Coach Carson, with a lot of these guys, they are giving up some of their active participation to create more passive features to it. They are, Zuber's still meeting with his property manager, I think he said once a week, but it's less time. He's giving up some of those returns. And I think as you grow your portfolio, once you've arrived there, you can make decisions to make it increasingly passive as you've stabilized it and optimized it. You can make choices to make it increasingly passive, just like I've done on my businesses, where I'm putting 60, 70 hours in the early formation of the business. Now I'm putting 10 to 15 hours into it, and my actual profit is higher. But I've paid, if you want to say, paid the dues.
So there is Brandon's YouTube channel also, if you're not there, but you can check out, he mentioned that video that he just put out recently about his rents going down, but his profits going up. But Joe V has a question, and I think he's asking just for a reference. He said, I agree about the 401k and millionaires. Do you have a source for the 3 in 100? Because I have a feeling he probably wants to show it to someone.
That's the government's own statistics. A lot of this is out in the last couple of years, that 3 out of 100 or 3% only have $1 million in a retirement plan. So those are statistics that published by the government and published by, I think it's Vanguard and Fidelity have recently put out some numbers too in the last year and a half. So that's where I'm getting those numbers. Right now, if you take millionaires, there's 24 million household millionaires if you include their homestead, their personal residence. You remove the personal residence from it, that number goes down to $6 million, or 6 million households, from 24 million down to 6.
DHW448 from your channel says, I disagree. In my opinion, buying companies that make something is nothing like Bitcoin.
I agree. I mean, it has a profit component into it.
What do you mean? Bitcoin is the future. Come on,
it's somebody's future. It's not mine.
I did, the clickbait got me, but there was a video on, man, what's his name? I gotta look it up. But basically the title was Bitcoin going to zero.
Yeah.
But I didn't expect. It was more like a shorter clip from a long video, but I didn't expect what the guy was talking about was the reason. Basically, he's this economist, but he was saying Bitcoin was going to zero because of how much energy it uses, and from a climate.
I saw something like that too. Yeah.
But yeah, so it caught. But yeah,
And
I
Bitcoin's
found that.
down what? Almost 50% right now.
Yes, it is.
Not quite, but it was for a period of time.
Yeah, but to like my well, we'll
But I
discuss
don't want
later.
to make this a Bitcoin discussion. I want to go back to what I'm talking about. I
But I
really
do
don't.
want
I
but
don't want
yeah,
to waste people's time.
well, but tune in on Wednesdays to the weekly Bitcoin wrap up, because Nick had a great example of how housing has crashed in relation to Bitcoin. Because if you look at how much Bitcoin it took to buy the median home, let's say 10 years ago, to where
Interesting.
now, right? So
Interesting.
even though it's you would need less Bitcoin now to buy the median home, right? So even though Bitcoin has crashed 50% from the high, it's still, you need less Bitcoin today to buy a home of median than it was 10 years ago. Whatever.
Yeah.
Well, I mean, something like that. But anyways, uh let's see, where were we at now?
So I want to go through some of the positives to passive investing because they have positives. You get more increased financial freedom. You have people like it because there's scalability without much increased effort. That's some advantages. Usually it's professional management on passive investing. Usually you can have more diversification quicker and lower stress. But the disadvantage, the negatives to passive on anything, the negatives to passives are lower overall returns. Now, I put a number, this is my own feeling on it, of passive investing. It's 1/3 to 50% lower returns on passive investing versus active. That's just a general number. I'm thinking I'm going to get that much less. You have less, the negatives, lack of control. Are they going to make the best decisions for you? Answer that question.
See, Bitcoin starts up the conversations,
I
though.
know.
But
That's why these Bitcoin people, that's all they can think of. I'm trying to talk about other things.
well, Momo gets money does say not just Bitcoin is down 50%. Even many fintech stocks are down. And then All Nighter Hider follows up with Bitcoin is a computer code. It's as much speculation as Brandon speculating his computer was going to work this morning.
See, this is
Uh,
this is why I hate even using the term because they just have to defend so rabidly.
But I think I also saw you comment, and we're kind of talking about like the active investing in stocks, real estate. But I think a lot of it is like you're saying, there's more levers to pull and you have more control. And I think
Yeah.
it was the Michael Zuber, Jason Hartman video. I forget which one they were talking about, but I think you commented on it also. And I think the key takeaway from that video was Jason Hartman was also talking about it. I mean, he may have said it's the only asset class. I'm not sure, but the asset class that allows you to always change the terms in a sense. So
Yes,
you
and I
can
did
change
comment.
whether the rate, you can change your, like you said, you can change your insurance, property, but there's more ways to make this kind of
There's
work in
numerous
whatever.
ways to
Yeah.
make it better. And also saying, and I want to go back to all of those different ways you make money in real estate work somewhat independently. So property values have come down in our area a couple of percent, but I'm still making cash flow and still making returns. Those are the things that I know you're watching stuff that I'm not seeing, but those are all things that work independently. I want to talk about those advantages of active investing, and that's what we are all doing this for, is to get to financial freedom faster. And that's the ultimate goal is for me is to be there, and I'm pretty much there. I've got a business out here that runs on its own without me. I only handle the accounting and moving money And every now and then I will talk to an owner. So if I'm putting in 10 hours a week, that's that's probably about it. And this company I've built to run on its own. The same thing with real estate. I chose to go the new construction route, and there's been a lot of discussions recently of people moving their portfolio from older stock to newer stock to have less active management. They're willing maybe to give up a few points in return to have to buy their time back.
Yeah, absolutely. And even to your point of going into the new builds, that's a lever to pull to make deals pencil out. Like you're saying, you've built this blueprint that works for you. But even yesterday's call with Cody Davis on our live stream, right?
Yeah,
I mean, I'm not sure if this would make a deal work, but for him, he traveled so much distance. I think it was 3 hours both ways to do the lawn at one of his properties, but to save some expense, right? So there's different ways to try and lower costs because you're the more active you are, and that also comes down to, like, if you even Cody, he's talking about transitioning a certain amount of his portfolio to self-managing. Justin Canberra's looking to transition a certain amount of his portfolio to self-managing. And for a lot of people, that's 10% right there that they're getting more. Yeah, they're going to have to be more active now, but they're getting a 10%
it
return right there.
depends.
So
Here's what I look at, and that goes actually where I was going next. So what people go after is freedom. Why we're doing it? We're wanting freedom, flexibility, and financial. And I think what people do is they go after freedom and flexibility first. If you're going with passive investing, you're going to get freedom and flexibility, but the financial might not ever come or might not come for decades longer. I'm going after the financial first, and then the freedom and flexibility come later as I've optimized all of my investments. And I do look at my businesses as investments to me because I'm not doing everything. I look at it now, if I want to make whatever return annually, let's just say right now I'm making $250 an hour. If I'm going to add any other efforts, it's got to be higher dollar amounts. If I'm going to get involved in active management and I'm now making less money, so I'm going to go drive, as Cody did, 6 hours round trip. I love him and I love the honesty because it illustrates things. I'm going to drive, for me now, for where I'm at now, I'm going to drive 6 hours to save $75. And I've spent all the gas money. I've spent all this time. It might not be the right decision. And that's the way I look at it is if I'm going to take a roll back, it makes me, this is where I'm at exactly today. If it's going to make me less than $250 an hour, I'm not going to take it back because I have the way to allocate those hours to doing other activities that I'm making at least now. I'm looking at stuff where it's $500 to $1,000 an hour effort, being these new builds. Me not being the GC, the general contractor on these, is the right decision because I'm making more money having my time used other ways to grow our wealth. I'm making higher return per hour effort. And so if I'm going to take back all these small minutia effort, and that's what a lot of people that are learning how to be entrepreneurs, they want to do it all, and they're taking roles that pay them less than their overall where do you want objective. If you're wanting to make money making $200,000, $300,000 a year, many people struggle doing the right activities to what that is to making $200, $300 an hour. I'm looking at what I'm doing and saying, I'm going to only add effort to where I'm making higher than $250 an hour now. That is how my brain works. And so real estate was one of them. I knew with my business, I could make really good per hour money of the amount of effort that I would do. So that's just how I'm looking at it.
I skipped over Victor's comment though. He did say, let's make a meetup at Costco and talk about Bitcoin. So he's trying to help the algorithm with those.
Yeah.
Um, Jovi does say, I promise it was all in his head, even in the Miata. And then Jovi says, ask Brandon, but I don't think even they sell Miatas in Texas. So I don't know if they sell the Mazda Miata.
I know a lot of those people use those to race. There's a
Oh,
big racetrack beside us, and they love those Miatas for track racing because of how light and quick they are.
DHW448 comments, I've tripled my ROI investing in stocks versus real estate since 2011. Not
Huh.
using leverage with either. Use both to build wealth. You want to touch on that a little bit? Or, I mean,
I'd want more specifics. Well, that's good for him. I know a lot of people that have done seems like the opposite since 2011 on real estate. So it just depends, you know.
He does follow up with I am a RE investor first still though. Yeah. Momo gets money says when you already have money, you can leverage it for time. Us broke people gotta trade time for money and level up our ability to earn. Hmm.
And that is what I'm saying. So at first you are putting more time into it and to build those returns. And then as you've attained the wealth, you can make better decisions or different decisions that give you more time back. It does take effort to get there. And that's what I'm
Yeah,
doing with my real estate. I'm very more active than I plan to be even 10 years from now.
yeah, absolutely. I definitely I think though that sometimes people jump right into the passive side too soon, or
Mhm.
and for whatever reasons, it could be like they're saying maybe their life is so busy on one front that they feel like it has to just be passive.
Everybody's different, different has different situations that they're having to navigate. They would make different, decisions.
But I also think it's more because that's just what they're seeing everybody else doing. So, it's like everyone next to you at your job is just putting it in their 401k or retirement, right?
It's
So you
hard when
feel like,
everybody else is doing that. Yep,
yeah,
I
and
agree.
you think you're doing enough in a sense, right? You're like, oh, this
You think
guy's
you're doing
doing
the
that.
right decision. You
Yeah.
think you're making the right decision.
I see Casey tuning in. Morning. I think he may have closed on something in Texas in the past few months. I forget. Gus is tuning in. What's going on with all the stock and Bitcoin comments? But they are here for a real estate pod. Well, we're talking about active versus passive investing and returns, and some people are just saying that some asset classes they're getting different returns on them. But we are talking about the active side of things, and especially like real estate, where you have more leverage to pull to make deals work. And I think even to that front, you like you're talking about in the beginning, you got to be more active. But even on Justin's live stream, I think Justin and Gus were on the live stream, and they were talking, or a little bit more about the self managing side. And I believe you left a comment on that video also, about the kind of.
Analyzing, I think that's what you're talking about. So if you're going to take over the active management, how much time will it take versus um, the return you're getting? Looking at, okay, I'm going to give some extreme examples, but I'm showing, hey, I'm going to save $1,000 a month back in my pocket, but I'm having to spend 20 20 hours to save that 1,000. So there I'm getting $50 an hour return on my effort. But what if your goal's to make way more than that? What if you could do some other activity with those 20 hours that makes you $250 an hour? It doesn't work in a vacuum. So you're trying to figure out what is the best return for my effort and looking to optimize that at all times. And that number can change throughout life. Passive has a cost. It's returns. Passive has that cost of returns, and in those returns, it's compounding of your wealth. Active has a cost, and it's effort. There's costs both ways, and you're trying to figure out what is the optimal way. For me, I'm sticking with right the moment more active, and I think there's degrees of active. There are degrees of active that you're willing to do. I want to get to that wealth number faster, increasing those returns. I'm going to put in the effort, but I'm getting paid for that effort. And I'm getting that compounding and getting there faster. Once I hit those right numbers, I probably will pull back on some forms of that active participation and be willing to offload some of that to get more time back. Just like Zuber does. He
Yeah.
gave up his he's doing the property management. He's only having to spend, I think he meets with them once a week where he has a meeting with them going over all the things on his portfolio, but it's only, let's just say, a couple hours a week. He's willing to pay for that so that's only a couple of hours a week for his portfolio. It might be worth it then.
Yeah, I think that's the thing that a lot of people miss, right? So I think a lot of people are starting to head down more the path of self-managing and leaning that way. But even Zuber admits, right? Like he's sure he's probably losing money. Like he's getting ripped off. I don't know if that was his exact words, but he's probably like, I'm probably
It would
getting
cost him
taken.
more than him handling it.
Well, he understands that he's probably overpaying for certain things, possibly, right, by having property
Right.
management. But he's willing to accept that because of the freedom or whatever else. So, he's able to spend all his time producing content, right? So he enjoys that side of things. So he understands that by having property management, it's a trade-off. And yes, he is probably, overspending or getting charged extra for certain things that if he was to take care of it himself, he would probably save money. But that's not where he wants to focus his time. And that's also, I think I mentioned it on the live stream with Justin and Gus, was that, I always said, a lot of people bash on the fire department for, we get paid for sleeping type of thing, right? We're getting paid while we're sleeping. But we always come back and say we're getting paid to wake up in a situation when there's an emergency. And that's kind of how I look at the property management side of things. At some point, I'm doing it more for the education side now, but it's more for where at some point it's going to be like, I'm willing to pay that extra cost to not deal with it in that maybe one situation out of the year that is the most inconvenient time for me, where it could be like my son's birthday party and there's an emergency at the property or something, right? It's like those are the times I'm willing to pay for. It could be one time a year that I need this property manager's service that would take care of this one situation, but that's why I'm willing to pay it. So that's my vision, is where I'm willing to pay that extra amount, but it's to get rid of those very, very inconvenient times that I don't want to deal with it at all, or I can't do it because I'm involved in some family thing, possibly, right?
And that's why I say it can change over time in stages of life, and it can be degrees of active. It's go ahead.
No, I was just trying to catch up with the comments.
You start, for me, I'm choosing to start active to build my wealth, and then and then I'm transitioning to passive after I've attained the wealth. I will transition even more passive. Y'all know we manage properties for other investors. They just want it as mailbox money. They want to be extremely passive for what they want. They're trusting us to make the right decisions. And that's what I meet with the team once a week myself, going through all the different things going on in the business to make sure we're making the right decisions, because I have more of a balanced perspective. I can see it from the owner's perspective. I can see it from the back end of what's going on with the hassle and the property management. And I'm able to give that perspective of both sides so that we don't, I'm trying to make sure we do the right things for our owners. And I've had to say, no, we're going to do it this way. I can see it from their side. This is the way I would want it done. And then there's other things I'm saying they don't know. We were trying to make the right decision on this hassle, this repair, this tenant that's causing the issues. I feel like my role is that balanced perspective, overseeing the big picture of the organization. I can see it from both sides because I'm living both sides, and I can give a very, I feel like that is one of my strengths, a very balanced, reasoned perspective of making the most optimal decision that's right.
Momo Gets Money says the most powerful way to build a real estate portfolio is with active income to fund it. I don't plan to make money my first 5 years necessarily. My main thing is to get a real portfolio built. I think the challenge today is the job market is so bad that many people will be forced into entrepreneurship as their source of active income because of automation and stagnation in the economy.
Yeah, I see that more coming. I mean, I grew up in an entrepreneur family, but I see it becoming increasingly, with the side gigs, all the different things people are doing, that wasn't as prevalent as it was even a couple of decades ago. That's the way people are getting ahead.
All right, I got to clarify. Stephen from the Bronx, retired FDNY says we don't sleep, we wait. So okay, so I had to clarify. We get paid to wait. I guess that's what I should have said. Um, Trade Better Harrison 99 says, speaking of stocks, Tesla down to $338. I'm weighing on how much the dollar cost average to get ready for the Optimus robots that will build Brandon's rentals.
There you go.
Hey, Chris is here. So just I want to remind everyone, Wednesdays, Joe, Lauren, and I are bringing on different school members every week. So we've done about 5 or 6 of them. So next tomorrow, Chris Ramsey will be joining us. So he's in Arizona. So he's also a coach. But come check us out if you don't know much about Chris and want to learn more about his story.
The
Uh,
question I think of, and I can put this out there, would you rather make 20% returns with some effort, with work, or 10% without it? That
well,
answer depends on what stages you're at. There's a
yeah,
lot of answers to that.
very true. And people might always get tired of Yasik saying it, but he says it quite often in the accountability calls, right? It's he'd rather take the easy $1 than the hard $2 any day. So, but at the same point, right? Like you said, it also depends where you're at in your journey. But for most people, at some point, it probably transitions to they always want that easy dollar instead of the hard $2 because at a certain point, it's you don't need that extra dollar to some
Well,
extent.
and each extra dollar you're extracting has an increasing effort. Every dollar you keep going to make it better and better and better, that effort gets harder. It's a magnified return. And where is the spot, in a sense, where the juice isn't worth the squeeze of the effort? And I think even Cody was saying that. At some point, he realized, hey, that those 7, 8 hours of my life to save that $75 of driving to save that 75 eventually became it wasn't worth it. And he realized that at some point. But he was trying to extract every dollar into his returns.
Hi there, causing trouble again. He said, is Brandon talking in guarantees and absolutes or varying degrees of speculation? Chris says, choose your hard equals choose your cost. Yep. And Luke Howard from your channel has a great question. He says, do you believe build to rent is ideal even for young investors with no prior experience in real estate?
I think for young investors, it depends on your background. That's a challenge. For me, I've had to have lots of years and decades of experience of building and knowing, having relationships. But I know there are. I mean, Cody's an example of that. He's starting to build now, but he had some experiences beforehand that have gained him the wisdom of even how to navigate these builds that are coming up for him. If you've not had some certain experiences, I think it's a little more advanced relationships that you've got to have and knowledge, because there's lots of moving parts I don't talk about a lot on the videos. As I'm managing these builds, I'm managing, all the expenses, making sure we're on track on budget, acquiring products that I need for the property, and there's just so many moving parts that I'm handling from a big picture perspective on the parts that I handle. Then my general contractor is handling a lot of his relationships. It is a more advanced. The returns are there, at least for what I'm doing. I'm getting increased magnified returns for this effort, and so it's worth it. But it took lots of years of relationships and life experiences now that I'm leveraging and optimizing all those experiences.
Josh Burdick says it's like the choose your own adventure books from back in the day.
Yeah.
Momo Gets Money says, let me know when there are robots that can do drywall, plumbing, and flooring.
Right. Right.
Speaking of flooring, though, and I want to give Jim a shout out, the Grumpy Contractor. If you haven't, go check out his YouTube channel. I'll throw it in the chat. But he went viral, man. He did a short little whatever
I heard
15.
that.
He might when I saw last night, he was at like 22,000 views on that little 15-second video. I don't know what it's at now, but so he's been goofing around with titles and thumbnails. So good, he got some traction there. Momo Gets Money says, true, life is hard either way, so choose your challenge and choose your reward. Good thing to remember when things get hard. Yeah.
And I've got a video, I think it comes out this Thursday. I've got two builds that I'm almost finished, so I'm starting the video series this Thursday that I'm going through from the beginning of the construction and talking about a lot of the cost per square foot for some of the major items. So be looking for that starting Thursday, and then I'm doing them every other week. I think it's going to end up being probably a 4 or 5 part series, because I'm going to finish out the series. Part of one of the last 2 videos is going to be an interview with my builder. Then I'm going to do a final one once we have it rented, going through all the final completed numbers with how it lands financially. And I bet you Brian Davila needs to watch it, because guess what? I'm making money in today's market.
All right, perfect segue. That was actually where I was heading next. So, if anyone hasn't seen, Michael Zuber sat down with Ryan Pineda and Brian Davila again, and it was very interesting. It wasn't as heated as the previous ones. However, the comment section was very
it was pretty heated.
Yeah, it was pretty heated. A lot of attacks on the three amigos and Zuber specifically. But what was your takeaway on that video?
Yeah, I agree with that assessment. It wasn't quite as heated. It's pretty interesting that in the comment section it got pretty spicy. I'm sure you're going to use it with Zuber coming up here, y'all's next video. I bet you'll be able to pull a few of those out. Yeah, sometimes you just choose not to get in the fight, and that's what I chose on this one, not to make comments. But I thought Zuber did a good job. He was the balanced wisdom in the room, and that's what I appreciate about his perspective. I think Pineda has gotten better with Zuber on a lot of these interviews, of not being more balanced in his perspective and seeing both sides. So I at least appreciate that, because in the earliest videos he was not there.
But we are talking about active returns, putting in the active work, choosing your hard. Did you get to the point, or I mean, I know you have different beliefs because of your religious belief, but to Brian's point of almost saying, if you're a young male, right?
Yeah.
Well, not
I
that,
don't
but
want to
just
get into that. He's crazy.
Well, just more to the point where if you're not making this much money, in a sense, you should be focused on these.
I think you
certain
should be
things.
focused, and I agree with the focus principle to it. A lot of people complain, but they don't put forth the effort and focus. And that's the good average person. They'll complain, and it's somewhat of a victim perspective versus staying focused on something. And I see it actually in our real estate industry. I think people as a whole, there are fewer people that are really good with focus, and people get caught up with the next shiny real estate model, and it prolongs their time to financial freedom. They're seeing that next shiny business model, the next trend, which, back then, I'm thinking back 10 years ago, short-term rentals was the new emerging trend, and a whole bunch of people jumped into short-term rentals. I think one of the newer niche is the build to rent. And I think also the rent by the room. Those are some of the niche type of models, and people are looking at that. The slow steady tends to stay. I always feel like the slow steady growth of wealth, picking one model, becoming in mastery in it, it grows over time. Sometimes the slower, deeper I earn the wealth, the less likelihood it leaves me. I think if you earn it fast, I see most people in life, the people that earn things real fast, let's just say lottery is the perfect example. They get flush with money, they tend to lose it fast. If you earn it over a period of time slower, you tend to have less likelihood you're going to lose it, and it doesn't disappear from you slower. That's just one of my perspectives I've watched in life. The quicker somebody gets it, and the lottery is the extreme example, they're just dumped with a bunch of money. Well, they never learn the discipline of how to keep it. And we just got to be careful in staying focused.
So Lynn is bringing up kind of what Brian went a little off the rails on, and like I said, there's different ways.
Yes.
So he did, yeah. If you're not making 100K a year, you shouldn't be having sex, and they kind of, like I said, then they kind of turn it to if you're unmarried, you shouldn't be having sex, and it's a different
Yes,
belief.
it's a
But
perspective I have.
well, but that's I didn't want to focus on. I was more about
Yeah, I
like
don't want to go that.
if you're not making 100K, right? It's almost like you shouldn't be watching Netflix at night. You shouldn't be scrolling your social media, that type of stuff, right? So people are if you're not making like maybe 100K, right? You shouldn't be complaining about the struggles or whatnot because
Because
you're
they said it's easy to make 100K.
yeah,
What's your
yeah.
thoughts on that?
I wouldn't say it's easy, but I think there is a lot of opportunities if you are focused on trying to make 100K. But to that point, I definitely, I mean, I probably wouldn't have agreed with it 15, 20 years ago, but it's like, yeah, it does make sense if you're spending time, watching Netflix and I would even related to that. I mean, something I used to spend a lot of time on fantasy sports, right? And I
Right.
still play them to keep in contact with friends, but I don't definitely know like the stats for this particular player anymore. So, before you'd be like researching players and spending time trying to figure out what his stats and then now I look back and I'm just like, yeah, well, how much time was I wasting on that when I could have been focusing on something else? So I do kind of agree. I mean, I'm not saying it's easy to make 100K, but if you're not, I mean, I would definitely look at where I'm spending some of my time.
Yeah, I think, I use this with my kids. First, we make choices, and then our choices make us. We're making choices every day, and those choices make us and that they have consequences, good or bad. And what you focus on, it pays dividends, whatever that focus is.
And like I mentioned, Chris Ramsey will be joining us tomorrow. He has a great comment in the chat. I believe he may have heard it from Coach Carson's recent video the other day, and that's where I was going to kind of end things a little bit possibly. But go check out that video with Coach Carson talking about not to listen to these gurus or whatnot on social media. But he brought up a great point of we are talking about active, passive returns, but he did say there should be a passive enough. There's no such thing as passive income or passive return, but
Passive
there
enough.
should be
Yes.
passive enough. And like to Chris's point, he does say Trees planted from a seed or a few months old that grow through various seasons and soil are more abundant and resilient than planting a 30-foot tree that is more susceptible. Sorry, maybe that wasn't exactly what he got from. So Coach Carson referenced it more to harvesting, right? So planting corn for
Yes,
one
he did
season,
mention
right?
that. Yes, I yes.
And every year, though, you're gonna have to replant the corn, harvest it. So it's like a business, right? Yeah, you can make money up front initially, but it's something you're gonna have to keep doing year after year. Where you plant maybe apple tree or something like these seeds that may not produce a lot in the beginning, but then at
Right.
some point it just becomes every
Well,
year
I think
there's
even owning the property, it will never be perfect completely passive. It will, as I've managed it well and handled it well, I would use the term it will become less active, but it will never be fully passive.
I gotta think passive enough
Passive enough.
or less active income. I don't know which one I like better, but
Yeah.
it's the same message, um, but yes, Brian Davila from the bald guy from the video did want an apology, and that's basically how that video started off.
Yes.
Zuber did give him credit, but Steven does want to point out Brian was finally right about interest rates not going down, but it's only because of a war that he absolutely had no idea was going to happen.
Exactly. He wanted to take credit for that, and that was nothing to do with him. Uh,
Yeah.
I agree
Uh,
with that.
but yes, if you haven't, well, maybe you shouldn't go check out the comment section because, like I said, me and Zuber will discuss that on Thursday during our
Yeah.
weekly comment section. But there was a lot of personal attacks there.
Well, and I did use this was gosh, we're working through weeks of conversations, but saying the one thing I think Brian I agreed with, but I'm saying he agreed with me because I've put this out for quite a while too, is that it is a small business. Owning real estate, even if it's one property, you're to run it well, you're running a small little business with smaller numbers, smaller transactions. As it grows, it becomes a larger active investment management business. You are handling to some degree a business. And he mentioned that, and that's I feel the same way. I'm running a business. It's just the product is real estate.
Sorry, I want to read this comment on Facebook. It's from Albert Bowie. It was I was promoting our live stream from for today that you don't ever share or comment and give a thumbs up, even though I'm trying to help promote us. But
I'm not on there.
what do you mean? I keep tagging you on Instagram. No, no,
If
the
do
other
I have an
Brian.
account? I don't know.
Yeah, I
Oh, you're
tagged
yeah,
the but it says I side more of a hybrid but passive leaning style in not only investment vehicles but methodologies and approach to knowledge acquisition and style of building networks. It requires a lot of active too to go to events and shake hands and lost baby time, but I'd say 60 to 75% active and 25 to 35% passive styles. This is an aside from tactical investment vehicles in the passive and active debate. This focuses on one's style or personality and how they approach the financial freedom topic. So yeah, I think it's
yeah,
definitely. I think I never would have even thought of like like going to Vegas for the event as active, right? Or going to networking events as being active investing because you are putting in that time
putting the
to
time
build
effort.
something. Yeah.
Yeah.
Uh, Oh yeah, Victor does say Zuber said you were right, but for the wrong reasons. Talking about the bald guy, absolutely. You know
Yeah,
what?
that's right. That is what he said.
You got a few more minutes? I want to ask you one last thing, and then, like I said, I've been asking a lot of people this question recently. You got some time?
Sure.
Okay, so the last question, and like I said, we skipped last week. I probably would have brought it up last week, but like I said, Zuber, Jason Hartman, Zuber's changing his tune, right? On can the average person become wealthy today? And now he really feels that, yeah, he says the average person cannot. So what's your thoughts on that?
I agree. The only people that are building wealth are not average. It takes above average effort. I 100% agree, because if we think what average is, let's just use statistics. Average don't reach financial freedom. They're making decisions. And so I'm there with him that the average person can't. It takes an above average effort.
Do you okay? I agree with that, but do you think the average person maybe 30 years ago could have became wealthy though?
I think there was an increasing amount that could, because we were in a season. Let's think back to the book that was written, The Millionaire Next Door. There was a season in the 80s and 90s where it was almost optimal because many people were putting their money in the stock market. There was a new injection of a whole bunch of people that could stick money in the stock market passively and save their way to wealth. That was when the average person could do it. The savings could get you to wealth. But because of what's happened over the last, especially 2.5 decades, you cannot save your way to wealth anymore. And we are at the, maybe not the front lines of realizing in the last couple of decades, you can't passively average save your way to wealth. It takes active investing, because the 80s and 90s, the returns were there. I remembered I was a stockbroker in 2000. They were talking average returns of 12, 13%. And now if you hear the same conversations, those exact same ones, they're talking now 8%. That difference in what the average returns are. But we also have to fight against inflation. Did you know that since 2000, both Republican and Democrat, I'm bipartisan on this statement, both Republican and Democrats, the printing of money has averaged 6.5% new money printed every year, year over year, since 2000 to today. That's the reason people can't save their way to wealth anymore. That little feature alone can't prevent you from getting there, because your money is melting away because of inflation with printing money. 6.5%. So that's why we see the CPI saying 3, but we know we feel it higher. I always say it's about double. Well, putting that in, that's at that around that 6.5%. That's what's happened when they're printing money. That's why that season 20, 30 years ago, an average person, I think a feature of it, this is my thoughts, a feature of it is the average person had a better chance of reaching financial freedom and getting to that 100,000, getting to that freedom number back then, because you could save your way to wealth. Now, people are starting to realize over the last couple of decades, you can't save your way to wealth anymore.
Yeah,
You have to do
absolutely.
something
You have
above
to be
average.
active. Well, you have
You
to
have to
be
be active.
active. Yep. So you have to be active. I think everyone agrees, like you're saying, average today, you'll be average. I think as
And
someone just
pensions are struggling with it too. Let's go to the few industries that still have pensions. That's why you're seeing pensions failing. They're still using the old savings type of model that's not keeping up with inflation. That's why pensions are struggling now, is because they're still using the old way of doing things, and that model is struggling.
well, to that point, I don't. Well, maybe I'd change how I would say that. I wouldn't say necessarily. Well, maybe every pension is different, but like for example, our the fire department, our pension is not necessarily failing. It's just putting a strain on the newer guys. So like,
Right, right.
yeah. So it is. It's not necessarily
And it
failing.
can't keep up with lifestyle.
Yeah.
For what they're going to pay doesn't stay in line with what the cost to live is. If we look back, I remember thinking in the late 90s, they would talk about $1 million was the dream, and that you would be set in the 90s with $1 million. Now $1 million buys half. Let's take 2000. $1 today, or $1 back in 2000 now takes $1.90 with inflation. So $1 million in 2000 for the same purchasing power of $1 million 25, 26 years ago now takes almost $2 million for the same purchasing power. The way of saving has changed to make it, because even in pensions, they're giving these dollar amounts that are some of many of them. And my wife's father is on a pension. It doesn't keep up with what's happening with the dollar.
Oh yeah, absolutely. Yeah, I think that's the one thing. So even like you were talking maybe 30, 40 years ago, people could just buy a home and that would be their retirement plan. I think more and more people are starting to realize that, not saying that buying a home is a bad investment, but especially if you can house hack or rent out rooms where it produces some income, and don't, especially, don't overextend yourself on buying your first home, right? Don't put all your money into this home and not realize repairs. And I think even Ike, I mean, Ike is more of an investment properties, but he said he's dealing with his third place with plumbing issues in the last week, right? So when it rains, it pours. There's always some sort of thing that pops up. But I did hear someone, the way they put it was, live off your wealth, not live in your wealth. So I think a lot of people were living in their wealth for a long period of time. So they had their home, their paid off home, and they were living in it. I think if you
And
can
that's why I'm
live off your
teaching
wealth.
our kids. I think it's so critical. And my kids are just out of high school, several of them. I'm teaching these juniors and seniors in some of these high schools how critical it is to get on the real estate ladder earlier. Using the house hack feature gets you there faster because of that K-shaped economy of the asset owners that have assets that cash flow. They are the ones that are going to get to financial freedom. The asset renters and the people that are savers are going to struggle for decades unless something massively changes in our economy. Those are the people that are getting ahead way quicker, are the asset owners that own assets that cash flow, that grow with inflation.
Absolutely. Well, let's see. Momo, let's wrap it. Momo Gets Money says most Americans live in their wealth because most net worth is in the home equity of their primary home. It's rare to house hack or own multifamily rentals. Yep. Well, I think that was what was kind of in, many people for 40. That's what I thought when I, was growing up, right? You just buy a home and you sit on it for 30 years, and now you're wealthy, right? But as we're seeing, times are changing. And to Josh's Burdick's earlier points, is you have to actively save to purchase assets. Rinse and repeat until you grow your wealth. Yeah, so definitely a lot of good points today, man. It's good catching up. Sorry we didn't get
Look for
to.
my videos, man. I'm going through these builds. They're starting on Thursday. I hope everybody will check those out. And I just acquired another lot that we'll be building, hopefully two more starting in November, doing this all over again. I do typically 2 to 3. Right now it's just two a year, where I'm building 2 properties a year, and I'm almost finished. So you'll see those videos and that series going on with the numbers, and have 2 more that'll start in November.
Did anyone reach out to you about your offer of
I've
taking off
decided
your?
I don't know if I'm going to do anything. I can't part with any real estate right now. So at this moment, man, I thought about it. I'm like, man, can I part with any real estate? I think right at the moment I'm not quite there yet.
All right. Well, thanks for doing this, man. Like I mentioned, I'll be back tomorrow, same time with Joel Lauren, and we'll have our school member guest, Chris Ramsey, on. So check it out if you don't know much about Chris's story. Should be a fun one. Dion goes live today, 4 p.m. Pacific time, I believe. And I believe there is a one called in school today. I forget what time it starts, but it's the real estate agent broker call. So tune into that if you got your license and want to talk to other people around the country. But good catching up with you, man. Like I said, we had
Yeah,
to skip last week. You were busy, but always fun catching up, man. So I will see you next week. Thanks for doing this, man.
sounds good.